This is the amount of money the American government borrows in just 10 seconds. Let's add that to their total government debt. $31 trillion is the highest level of debt held by any country in history. While global debt has just risen at the fastest rate since World War II. Put another way, total worldwide debt is now 3.5 times higher than worldwide GDP. Does this mountain of debt pose an existential threat to the world economy? Or is it just the price of doing business?
This is unprecedented, this level of debt. We don't know how that's going to play out.
The reckless borrowing of what was considered cheap money in 2008 toppled governments and ravaged economies.
It was the worst day on Wall Street since the crash of 1987.
We're now down 43%.
But did governments and banks learn their lesson?
Today the story is different because we have higher interest rates, higher inflation.
Or should the world brace itself for another debt-driven financial shock? Before we go any further, just a quick reminder that we produce video explainers here at Capital.com on all types of subjects related to the markets. You can visit our website here, click on the link to watch our recent explainer on how to spot the bottom of the market. 3 waves of debt have broken over the last 50 years. Each one left recessions and financial crises in their wake. The current wave is the largest and grew the fastest, and it still hasn't broken. So why do governments keep borrowing?
A government borrows if and only if it is spending more money than it is taking in revenues, and where the revenues are usually taxes.
Countries started taking on debt in early modern Europe to fund expensive military campaigns. Today, governments borrow from the financial markets by issuing bonds, which are basically interest-paying IOUs.
Typically, governments don't want to burden their voters and their donors with taxes. Meanwhile, the voters and the donors want all kinds of services provided by the government. Politicians are therefore caught in the middle. They need the voters to get elected, and they don't want to dissuade them by taxing them. Therefore, a popular solution that the politicians find for the structural dilemma they're in is to borrow the money.
But debt isn't necessarily a bad thing. Some see the problem of debt more like gun control. It's not the debt that's the problem, but the people who use it irresponsibly.
Public debt is not a bad thing in itself. It's the way governments spend the money they borrow that can actually tell us whether debt is a blessing or a curse for an economy.
Typically, the bigger your salary, the more money you can borrow. And the same applies for countries. But if you're expecting the richest countries to run the tightest ships, you'd be wrong. For this film, we're looking at the ratio of government debt to GDP. If an economy is worth $1 trillion a year, but its government borrows $3 trillion, its debt ratio is 300%. This chart shows the countries with the highest government debt ratios. The G7 countries, a group of the world's most advanced economies, all run ratios of near or above 100%, with the exception of Germany. But out on its own is Japan, whose government borrows almost 2.5 times more than its GDP. But Japanese debt might be less risky than it seems, because when Japan needs money, it doesn't turn to the international markets. Japan borrows most of its money from itself.
The bulk of that debt is held domestically. There is a very low foreign investors base. 43% of the Japanese debt is owned by the Bank of Japan. So the Bank of Japan is the biggest holder of Japanese government bonds.
If you subtract the amount of debt that's actually owned by public institutions from the outstanding debt of the public sector, it's much, much lower and much more normal.
But what about the debt levels of the poorest nations? Borrowing is all about trust. Countries need to show debtors they can pay back what they owe, because without trust, things can unravel even for richer countries.
I want to be honest. This is difficult. I am resigning as leader of the Conservative Party.
Which is why the least indebted countries are often the poorest. The average GDP to debt ratio of advanced economies is 110%, but that falls to just 66% for emerging markets. Comparatively small sums can tip emerging markets into default when a country can't service its debts.
Most countries in Latin America have in the past repeatedly defaulted on their foreign borrowings. They've had to borrow. They've had to borrow at inordinately high interest rates.
Since 1989, there have been 36 defaults, amounting to almost $750 billion. That's less than a third of the market cap of Apple. There may be a fresh crunch point coming in 2023. To curb surging inflation, America's Federal Bank has been hiking interest rates, pushing the dollar to a 20-year high.
Jerome Powell signaled interest rates will be kept higher for longer to bring down the inflation.
The US dollar is, of course, the world's reserve currency, and it is on an absolute tear.
Many emerging markets owe their debts in dollars, as it's harder for them to raise money against their own more volatile currencies, which means their borrowing costs have gone through the roof.
These countries are literally thrown over the edge because they could barely make the payments on the debts they incurred for economic development, for coping with COVID-19 before, but at higher interest rates, they can't. And so they will declare bankruptcy.
Severe debt has now spread to a fifth of the population. The debt ratio of developing countries may be low, but the risk of default in an era of rising rates is very real. Whether you pledge your allegiance to the flag or you're ashamed of Americana, you need to know about American debt. America has more government debt than China, Japan, Germany, and the UK combined.
Pies are done.
But which nations own the biggest slice of the American pie? The UK is America's third largest creditor, owning $645 billion of their debt. China comes second with almost $1 trillion, and in first place comes Japan, who own $1.2 trillion of American government bonds. But let's raise our sights from America to the rest of the world. Which countries live their life in credit, and who makes their money by taking on debt? To work out how risky or trustworthy, each country has a pithily titled Net International Investment Position Number. If you have a plus number, you're a creditor, and a minus score means you're a debtor. 2022 has been a tough year, so let's take the good news first. The Canadians are owed over $1 trillion by the international community. Mainland China, Hong Kong, and Germany own huge swathes of the world's debt. But it's Japan, again, who tops our creditors chart, with $3.6 trillion of assets. Which leaves us with the gluttons of the borrowing world. Greece comes in 10th, still paying off its debts from the sovereign debt crisis. Western Europe features strongly, from the UK in 6th place to Spain, owing almost $1 trillion, but way out in a league of their own, as a net debtor of $18 trillion, is Uncle Sam.
The United States gets an enormous benefit. It can buy things around the world, purchase the fruits of the labor of people everywhere, give them in exchange a little green piece of paper, $1 or a currency dollar, and the deal is done. It costs nothing to print those currencies. It's a fantastic privilege.
The US is the biggest economy in the world. They can maintain such a high level of debt because there is trust in the system. As long as there is trust in the economy, in the system, you can always find a market for that.
Here's a refresher of 2008's financial crash in 10 seconds. Banks lent money to people who couldn't pay their debts. Governments then used public money to bail out the banks and cut back on public services to balance the books. The result was that lots of people lost their jobs. But is global debt today more or less scary than it was in 2008?
This is unprecedented, this level of debt. We don't know how that's going to play out. Once you're linked in through debts, where everybody is caught up in a web of debts and all the derivative financial instruments that are built on debt, you can't be sure how far that will ramify.
Since 2008, the debt mountain has grown much, much bigger. Back in 2007, global government debt was around 70% of GDP. By 2020, it had risen to 124%. Let's take a look at central bank holdings of public debt for the G7 countries. In 2007, German holdings were just 1%, with America and Japan top on 9%. Here's how that picture has changed today. Canadian banks now hold 18% of public debt, while Japan tops the list on 43%.
If we look at the United States, in 2008, the US had a debt to GDP ratio around 60%. That was before the great financial crisis. In 2021, the debt to GDP level of the US government was 137%. So it more than doubled in 14 years. So that was a massive surge.
But there may still be a glimmer of hope hiding under that debt pile. There are causes for optimism. For starters, 2008 wasn't that long ago.
I think the main difference between today and 2008 is that 2008 has happened, so we're much more conscious of the risk of financial crisis, which means the banking sector is much better able to withstand economic shock.
The picture also might look brighter depending on.
The inflation rate in China about 1 to 2%. Nothing like that in the West. The level of debts in China, very low, not like what we have in the West.
There may be a higher debt burden today, but it's held in different ways by a different number of people. The fourth wave of debt won't last forever, and when it does break, some countries may find themselves on higher ground than others. But while the world thinks of a solution, American debt keeps growing bigger and bigger. Thanks for watching. Remember that the price of stocks and shares may vary depending on changing market conditions. You can read more of our analysis by clicking on the links in the description below. And don't forget to subscribe to stay alerted to our regular chart analysis videos each week and other explainers on big financial topics of the day.
Sooner or later, gotta cut you down.